Barn, obviously the other backdrop is Amazon Prime launching an ad tier. How does that sort of shake up this landscape in your view, if at all?
Well, I think that advertising is certainly a great way to go if you're looking at a consumer that's going to be stretched in their pocketbook. They're looking for ways to save money on streaming. It's one of those places where I think the surveys say consumers feel like they're overspending. So I think it's well positioned. For Netflix, it's not large enough, I think, over the next couple of years to really move the needle, mainly because of the limited number of people coming into the ad tier. The big game at Netflix is going to be paid sharing, where I think a lot of that's largely digested in the stock price. And I'm not sure that there's reason to jump in today to play that wave at this point.
Hey, Barton, it's Tim. How do you think about the multiples in the space? So there was a time we were paying any kind of a growth multiple, and we were paying it based upon subs growth, and there's a lot of different math you could do. At this point, Netflix is the only company that's profitable. And so the good news for Netflix and their shareholders is this is a company that's going to have $8 to $9 billion in free cash flow by 25, if you read the JP Morgan report. I haven't seen yours. But what's the multiple you're putting on these names at this point, at least those that are profitable?
Well, look, I think that we're trending towards, certainly for Netflix, a future that's mature, right? So they're going to be making money and their multiples kind of come down. And you got to look at the intersection of those two things. And in my mind, in some number of years in the future, you're going to trade this at a low double-digit multiple of free cash flow that's only growing modestly because they would have penetrated the subscription opportunity. And the ad opportunity will be a grower, but not, a barn shooter. So you're transitioning, and that's a difficult place for a former growth stock like Netflix.
Did it surprise you, Barton, to see all the streamers up on the back of this Amazon ad tier news?
A little bit. Look, I've got certainly a cautious take on some of the others. I've got a sell rating on Warner Brothers, a sell rating on Paramount. I do think that in streaming, we're in a difficult kind of transition. This is an industry that Netflix is winning, but it's a business that is difficult. It is one that nobody's leaving quickly. And it's one where, nobody's really been able to make money except for Netflix right now. I think that there's a lot of volatility around stocks that have been pressed down as much as Warner Brothers and Paramount have. And I think that's more what's going on than this being a fundamental revelation of something different in the business. We already knew they were pivoting to ad-based portion of their business and streaming. This assists in distribution, but it's not terribly surprising.
All right, Barton, great to get your take. Thank you.
Great, thank you.
Barton Crockett of Rosenblatt. Guy, which name do you like the most, or which one do you like the least? That's interesting too.
Well, we've liked Netflix for a while, but I'll say out of those three, given the run Netflix had, maybe Netflix the least, and I'll tell you why. Back in December of 21, the stock went from 700 to 400, basically in about 10 or so sessions, and that first place we stopped at before the next leg lower was about this 405 level. That's where we are now, and this move from about 175 to here has been effectively unabated, maybe one or two sell-offs along the way. So I think Netflix is a great company. I just think the stock has gone way too far, too fast, and I think you're definitely looking for a pullback in Netflix over the next couple of weeks.
You just invented another game. What wouldn't you rather? With Guy right there.
Kind of confusing, but sure.
Yeah, I agree. It looks like it's running into resistance right here from that March 2022 level. How long can you get the extra yardage out of the same story, password sharing? It's a direct play, but I think it's overdone now to the upside.
Well, you two are hoping for a long time, right? You're going to get more out of this one.
Well, I see this as totally margin accretive. I mean, let's be clear. I mean, you're taking borrowers, we're calling them, people that were, and they're saying, so the JP Morgan's note out today says that 50% of those will become new subs, 50% of those will essentially become, folks that are in the ad tier. And if you look at where that's an extra $2.5 billion next year. So, I mean, there are numbers you can really apply to this. And I go back to when they made this announcement, it wasn't out of weakness. It was out of strength. Even though, yes, saturation levels were things I was talking about with Netflix before I owned the stock for a long time. So I look at that free cash flow generation. There's no one even close. You stay long.